everybody. Hope we're all doing very well. Welcome again to our weekly seminar series. Before I introduce our speaker today, I have one housekeeping announcement. As you know, next Wednesday week is the last day of classes, so it means that your term papers will be due on next Wednesday, and we would want everybody to submit their term papers through the Canvas portal online, and that's going to be set up today by the course TA. So if you can kindly submit your papers via the Canvas portal and make sure that those are submitted before the deadline, which is going to be next Wednesday. If you have any questions at all, you can contact any one of the professors or the TA for the course, but it should be self-explanatory. So it's my pleasure today to introduce our speaker, Dr. Andrew Mude, who is coming to us from African Development Bank in Abidjan. He's currently the lead for agri-SME development in innovative financing in the Department of Agriculture, Development and Rural Finance. Previously, Dr. Andrew Mude served as a principal economist at URI, where he led so many innovative programs. One of them, which was the index-based livestock insurance. For this, he won the Norman Borlaug Field Award for this application for field work, a very prestigious award. I should also say that Dr. Andrew Mude is a Cornell alumni, and should probably ask him why that does not appear on his bio. He's a proud Cornell alumni. Yes, he was from, I think he did his PhD at Cornell and undergraduate at Gettysburg. Dr. Andrew Mude is also a very good friend of mine. We work together at African Development Bank. We met here at Cornell. I look forward to hearing his insights on what is happening in the space of financing for agri-SMEs. He's going to give his presentation, and we can hold to the end for Q&A and hopefully a fruitful discussion. And without further ado, I introduce Dr. Andrew Mude. Thank you, Andrew, for joining us this afternoon.
Thank you very much, Ed, for having me. Always a pleasure to have a chance to engage with you and also with colleagues and students. As Ed mentioned, I think I have to relook at that bio. I certainly shouldn't believe in out of Cornell. Maybe I was trying to fit it all within a page. It's always a great opportunity, a proud moment to be able to speak to Cornellians at Cornell, in a sense. I remember the last time we had this opportunity, Ed and I were giving a talk at the International Nutrition Seminar just about a month. I think it was on election day. So I think, this session should be decidedly more certain or under more certain or less tense terms. But it really gives me a great pleasure to come to you from Abidjan, Côte d'Ivoire, which is the headquarters of the African Development Bank, where, as Ed said, I work as the lead for agri-SME development and innovative finance. When Ed was here a couple of months ago, we were actually in the same department of agricultural of the agriculture and agro-industries, where I was leading the division on agricultural research, production, and sustainability. So it's just actually about a month now that I've moved into this new position. I moved because it's an exciting, growing space, as I'll hopefully convince you of. It's a gap that exists. I talked about my previous work on index-based livestock insurance, and in a way that was an innovative finance product to de-risk production of livestock keepers. And in a sense, innovative finance serves to de-risk the provision of this very important input to grow agri-SMEs, so which play a very important role for African agriculture. So I'll go into my, is it moving on your end? Okay. Maybe I'll start my talk with just providing you a broad scope of the context of African agriculture. I trust many of you being in this course might be broadly aware of it. But in general, we find a situation where, the population in Africa is growing extremely rapidly, about 2.7% per annum. The labor force at 3% per annum and growing faster as the increasing ranks of youth come into the labor force. At the same time, there's an increasing urban population, a growth of income, and so what you find is that much of the food demand, much of the marginal food demand going forward to the end of the century will occur in Africa. In fact, the bulk, and so that by 2010, 70% of the food demand will be in Africa. Now, over the last couple of years, we've had an increase in our food import bill, on the net food import bills. We now import about 10% of the total food production that we consume. Of course, that is a figure we would like to reduce, as any importation of food is basically an exportation of jobs, an exportation of value. And as you can see, agriculture in terms of the source of food, and for us also a real opportunity for an engine for growth and for the provision of the jobs that need to sustain a growing youth population. It is fundamental for us to ensure we increase the production of agriculture and meet these needs. Now, at the same time, when we are strained with a similarly low agricultural production, as I'll demonstrate later, our agri-food systems continue to be impacted greatly by a lack of resilience to things like climate change. We have increasing environmental degradation to our soils and so on. So these trends are trends that must be considered when we try and figure out what are the real levers for boosting and catalyzing Africa's agricultural transformation. As we consider that, this graph coming from Fugo et al., you can see that the really considerable regional productivity differences, both land and labor productivity, both land and labor productivity. You can see there, sub-Saharan Africa in red is quite low, both in terms of land and labor productivity. And yet this represents not just a challenge, but given the food production demands, it really presents an opportunity for us. The marginal returns to investment in land and labor is going to be much higher in sub-Saharan Africa. Sub-Saharan Africa is also endowed with the majority of the world's available arable land with generally favorable conditions. So the cost of land, the cost of labor is also quite low, and the opportunities with technology transfer, knowledge transfer becoming a lot more efficient. The returns to investment in sub-Saharan Africa could be considerably high. Now, the question is just how to unlock the opportunities that will take advantage of these of the increasing outputs in land and labor. Now, of course, for us, agriculture also provides 25% of our GDP, continent's GDP, 70% of the employment. So it's a hugely important sector for us. Now, we had the African Development Bank as a result. Typically the African Development Bank has been an infrastructure bank, but over the past since 2015, we embarked on a real focus on food through our Feed Africa strategy, which is one of the 5 pillars of our core investments. And really our Feed Africa investments through Feed Africa strategy have been increasingly markedly since we launched it in 2016. You can see here the vision is basically a recognition given the context of agriculture and its immense importance in terms of being able to deliver on nutrition outputs, being able to deliver on food and nutrition security, being able to deliver on jobs. So really is to transform, invest in the transformation of African agriculture, but recognizing fundamentally that in order to do this and to unlock the value in African agriculture, we have to unlock and invest in the agribusiness sector. We have to create wealth. We have to create value addition. We have to increase the productivities of land and labor, as indicated, and we need to do it while protecting the environment and in a way that is inclusive. So if you look at the goals are quite clear. We see agriculture as an engine to income, ending poverty, and to improving livelihoods. We also see it as a main target for catalyzing our economies. And if you look at some of these outcomes and outputs as indicated here, you'll find that a lot of them focuses on the role that commerce can play, both large scale and small and medium scale commerce, where we seek to unlock at least 20 billion in private sector investment into agriculture, where we look to move up the value chains, increasing value addition by processing in commodities such as cocoa, cashew, and cotton. And you can also see values, a focus on agribusinesses. Now, this was a strategy that was launched 5 years ago. We are going through our midterm review. We recognize that the context is changing. The demands on our agribusiness sector and the opportunities are also changing. And so we expect to shift these numbers to become much more ambitious, to really make sure that we can meet our targets, and we can do so with an agri-food system that is not just inclusive in terms of delivering jobs to youth and women in an effective way, but also one that will be resilient to shocks such as COVID, climate change, a whole range of pests and so on. So this is really the focus. Now, when it comes to agri-SMEs, what role do they play in terms of African agri-food systems, and in terms of some of the outputs that we're looking to generate from the African agricultural sector? Well, first of all, 80% of all the food that is consumed and purchased in African households is done so by supply chains that are delivered by small and medium enterprises. And we see that the number of small and medium enterprises really are increasing quite rapidly. Over the last 2 decades, the number has risen by over 800%. And this is, under a context in which the support going to agri-SME is not as it could. So the potential is much greater. The potential in terms of the provision of jobs and provision of value. And what are these jobs? What are these SMEs? Also, the SMEs in terms of serving production. A farmer in some can be constituted as an enterprise, but really those enterprises serving the farmer at the local level, providing seeds, providing crop protection instruments, providing fertilizer and manure. We have the trader who takes food from the farm, aggregates it, takes it to your local informal market to sell for the day, or aggregates it for onward sending to agent. We also have transport. The transport and logistics are extremely important in terms of agriculture. Being able to take food from rural farms to urban towns, all the way to cities. Warehousing, cold storage, and so on. SMEs are also quite important in the general economy. They constitute up to 70% of formal employment in sub-Saharan Africa, and up to 90% when you include in the informal sector. But this is the general value of SMEs across sectors. When it comes to agriculture, SMEs in agriculture only provide 25% of the current employment. This is because of the challenges that exist in providing support to agri-SMEs, the particularities of the agricultural production system, the seasonality, and so on. So what you have is that despite the importance or the recognized importance of agriculture in terms of economy, jobs, and so on, Loans to agriculture still represent only 6% of the total lending of commercial banks. And at the same time, on a more national level, African countries are also underspending in terms of budget commitments that have been made through the CADEP, which is the Continental African Agreement, the Continental Agreement for Agricultural Development, where a commitment was made about 10 years ago that all African countries would spend up to 10% of their budgets on agriculture. Most of them don't spend even less than 5%. So there's a coalescing recognition that these commitments, both at the national public level and to support and catalyze private sector investment into agri-SMEs, need to occur. So let's look a bit more, at what exactly, where is this finance gap and why do we see it? Well, estimates and studies have shown that the annual financing gap for agricultural finance in sub-Saharan Africa is about 240 billion a year. The current annual supply, growing though it is about 60 billion a year. So you have a general financing gap of 180 billion, and this is to the private sector for agriculture. Now, if we break this down to areas of focus, so the SMEs, for SMEs, this is 96 billion. And this is SMEs that are defined as those enterprises within the agricultural sector. Some of the examples that I gave, but those that require investments of between $25,000 to about $5 million. Now, because those businesses typically that require enterprises that are at the level that require financing needs above 1.5 million generally are more likely to be able to access those kind of resources. What you find is this missing middle, this gap of an increased difficulty in accessing funds between those for those SMEs between $25,000 and $1.5 million in terms of financing need. Now, why is it that we are focusing on this segment? What about the micro enterprises? What about subsistence farmers who are trying to commercialize or require loans in order to purchase hybrid seed or purchase fertilizers for a particular season and so on? Well, in general, these are a class of enterprises that are typically served by microfinance institutions. They're typically served also by local banks that have spread several local banks across the African landscape that have infrastructure across the urban and rural areas of the countries. Also are starting to be able to deliver finances to that at a small amount. These are finances that are probably they're less than a year in length, and so because they're lower in term and lower in price, in value of financing, they're also lower in risk. So in general, the financing gap there is not as much here. It looks, of course, 84 billion. It looks quite big, but when you compare the number of agents that are small, that are SME class between 25K and 5 million, with the other number of agents classified as micro enterprises and your typical subsistence farmer, the per enterprise needs of SMEs and the financing gap needs of SMEs are much larger. So to go to the challenge, why is there this gap? Well, first of all, in terms of the risk of lending to agri enterprises in Africa, we find that they're generally about twice as high as in other areas. Agriculture is also a risky and or more complex sector. So even within African countries, we find that agri-SME lending is actually lower on average than other sectors in similar countries. We also find that actually banks, commercial banks across the African landscape, actually have higher levels of commercial return across their portfolio compared to commercial banks in Latin America, in Europe as well, and so on. That is largely because of a dearth of or a lower competition. It's also because of a lot of government lend quite heavily at attractive rates. In the case, the opportunity cost of lending to agri-SMEs become quite relatively high. But I think these statistics mask some trends that are encouraging. First, for those banks that are that have begun to look at the agri-SME space of potential to invest in and have actually begun to help agricultural departments, where those departments have matured beyond 2 to 3 years, we're finding that their rates, the rates of return on agri-SME, those banks equalize with their rates of returns across other sectors. That said, the economics of commercial lending to agri-SMEs, when looking at risk return profiles, when looking at opportunity cost of lending, are still not very attractive. So we need something else to tip the balance. And tip the balance, or what it is, they do not account for. A commercial lender that is profit seeking cannot account or integrate the non-financial or the non-commercial value of the portfolio that they are loaning to. And when it comes to agricultural SME, there is growing recognition amongst the public sector, development financiers, impact investors, and so on, that agri-SMEs really can be a vehicle for significant impact with regards provision of jobs, for example, particularly jobs to youth. When looking at also, including the jobs to providing livelihood opportunities across the gender scale. Also, when you look at some of the commitments toward the needs for transforming agri-food sectors, given the challenges of climate change, given the challenges of environmental degradation, biodiversity loss, agri-SMEs are also seen as vehicles that can really help to be able to minimize the damage of the agricultural sector in those areas and maximize the benefits in terms of the food nutrition security and some of these other issues that I've mentioned. So the question then becomes, how do we integrate this non-financial values into the economics of lending to agri-SMEs? And so what we are now seeing is because of this recognition, because of the shift in looking at agri-SMEs also as a source of not just commercial return, but of social and economic impact. We are seeing at a broader scale in international finance markets with international finance institutions, multilateral development banks, also nation states. We're seeing a real increasing commitment for value-based investors. We're seeing a real increasing concern about the role of climate change, increasing concern, of course, also a wake-up call in terms of the impact and the necessary response to COVID that demonstrates the importance of building resilience into these systems, of ensuring we protect and produce food that has positive health outcomes, but at the same time does so in a way that is sustainable and protects the environment going forward. So in fact, recently, just as an indication of this growing commitment, we found that there was a declaration in the Financing in Common Summit. This is a summit of all multilateral development banks or public development banks across the globe, where they made an affirmation that their investment patterns, their resources that they'll be or the portfolios that they'll be investing in will need to be able to demonstrate their alignment to providing impact according to a whole range of the Sustainable Development Goal indicators. And this will be across, of course, let's say SDG 2, which is a zero hunger and has food and nutrition requirements. It's also, you know, the various SDGs around climate change, around gender equality, and so on. So what does therefore this mean? So this has given rise to a new type of financing in which we at the bank are also, you know, playing looking at increasingly as a way for us to increase the support we provide to agricultural SMEs. And that is what, you know, is being termed blended finance. And this is where you use the commitment and the leverage of public resources. So from multilateral development banks like the African Development Bank, the World Bank, the nation states, and so on. So you use those resources to leverage and to de-risk commercial investors, so that they can price the impact that is of value to public resources, public institutions. And I will give you a sense, an example of what these look like and what they mean in terms of the type of instruments, the types of resources that will be driving increased financing in agri-SME. So some of the objectives of blended finance, well, one of them, of course, is to reduce the risks that we highlighted, for example, for these private investors, commercial banks. And we do this through a means of various instruments, such as credit guarantees, that share risk with your commercial lenders. So the provider of guarantees, usually the public sector impact investors, they agree to cover default risk that will be incurred by an agricultural lender, allowing the lender therefore to increase to shift the risk return profile and increase their lending. Another is another set of instruments or target the objective of really increasing returns to commercial providers. And so these are usually a set of, you know, debt or equity products through, for example, you know, what we call first loss equity is one example. And this is one way in which a public or development financier will come in and will guarantee the first loss, that they would absorb any of the initial losses that a private financier might occur from any private investments, therefore increasing the expected returns. Then, of course, social impact, and here we're seeing, for example, the African Development Bank to raise funds to support the COVID response needs of our regional member countries. In March or April this year, launched a record-breaking $3 billion social development SGD bond, and this bonds, the proceeds of this bonds need to be used in very specific ways that meet the criteria of a growing set of these value-based investors that are looking to provide resources at concessional rates to help on lending for social impact criteria. And then, of course, as you will see for the set of examples that I'll provide going forward, this is also a new space. You know, it is not just risk that constrains or reduces the appetite of the private sector to invest in these areas. It is also, you know, a lack of or low volumes of bankable or investable opportunities. You have a lot of, you know, SMEs that might not have the capacity to, might not be profitable simply because of their capacity. Might not be sitting on an enabling environment that will be able to assure the provision of return. And so a lot of the resources that are being provided now are grants to help to develop, you know, the right kind of policies, to develop the regulatory frameworks, to be able to monitor the provision, you know, whether impact funds are actually generating the impacts that are intended, and to really build an army of skilled agri-SME agents, if you will. So I think given that broader the timing, given the context, I'd like to give some examples, particularly of what new instruments that target leveraging of private sector funds to agricultural SMEs and to a range of other impact indicators. So one of them is the bank recently launched, the African Development Bank recently launched what we're calling the Affirmative Finance Action for Women in Africa, or FAWA. And so this targets women-owned businesses, small and medium enterprises that are women-owned, women-led, or have a significant fraction of the employees as women. And the idea again is to really leverage the public funds that the donors and the African Development Bank provides to unlock private sector financing for women businesses. And basically the aim is to unlock 5 billion. I'll show you the structure of the funds. This is to FAWA targets 3 pillars. One of which is the agricultural sector, the other is fashion, and then also ICT. It has a couple of pillars, and these are pillars typical of these type of de-risking instruments, where it is the instrument to provide finance, but also, as I mentioned, a set of other support to build capacity of the financial institutes, build capacity of the businesses, but also to begin to develop the enabling environment. So your policy reforms and legal and regulatory frameworks and so on. Now here is how the structure of AFAWA. And so AFAWA, the donors, the G7 in Netherlands provided $300 million to the bank. The bank added another 450 million of its own funds, and this becomes now that guarantee pool. That protects private sector investments and allows for leveraging. And so the bank is working, we are working with the African Guarantee Fund that has set up just to provide this kind of guarantee instruments. And they're going to then work with a whole suite of African private finance providers to unlock the rest of the funding to at least 100,000 African women-owned businesses. And this is something that already has launched earlier this year, and it allows the bank to go beyond what it can typically do. I think what I failed perhaps to mention is the bank, the African Development Bank, as most development banks, have 2 lending windows. They support both nation states, so sovereign operations, but we also have a private sector lending arm. Now the private sector lending arm, we are only structured to be able to lend to companies that can take a minimum of $10 million dollars of loan. And so you can see this is certainly not that missing middle of SMEs that we believe, as I mentioned, is essential to catalyze the agricultural transformation. So that is AFAWA. We have another instrument we're calling the Ghana incentive-based risk-sharing system for agricultural lending, or Gearcell. Here is where we embed a component to support agricultural SMEs through a public sector project. So Gearcell is actually owned, or the main shareholder is the Ministry of Finance from Ghana, though it has been set up as a non-bank financial institute. That serves, that provides a whole set of the instruments that, the risk-sharing facility, a technical assistance facility, as I've been mentioned, and then a whole set of other enablers. So just an example of what this means for bank rating, for example, is a service that any banks that sign on master agreements with Gearcell. So far in Ghana, since 2019, when they started, there have been 15 financial institutions that have signed up for Gearcell. And what Gearcell then does is that they begin to engage them through a specified monitoring framework to then be able to rate rate them according to a set of indicators that will then also determine their suitability for the receipt of other impact investment funds directly from other providers. Another important aspect of this, a lot of the growing pool of de-risking instruments, guarantee products, really taking advantage of digital financial services as an important soft infrastructure to really begin to both reduce the cost of provision, to reduce the cost of providing technical assistance, capacity building, and also to be able to reduce the cost of tracking. I think timing, how am I doing, Ed? Maybe I should move.
I want to leave a little bit of time for Q&A, so maybe 2 or 3 more minutes. So.
I'm almost done. I think what I'll this is just to show that another mode of support is private equity. This is there are a growing list of private equity funds that are focusing on agricultural lending, and this is they typically, of course, they're the type of aggregators that we need, so we can provide, like I said, loans for above 10 million, but these are then the private equity funds can take this support either as debt or equity and on lend it, and they have some specific value because they typically have a set of expertise, and providing them support not only demonstrates proof of value, and in that proof of value, we are seeing an increasing number of entrants into private equity for agri-SMEs, both at the continental level, and now more and more also global providers of agri-SME services are coming on board, having seen the demonstration effect of some of these equity funds. And as at last count, about 27 funds are now investing in the agricultural content. I provide here some of those that the African Development Bank is currently investing in, but this is a fast-growing mechanism. So finally, I guess some of the insights and the opportunities that we're seeing to accelerate provision of to really catalyze the development of agricultural SMEs. Well, first of all, is the policy to really get some of these big impact investment funds. For example, some of the biggest funds are pension funds, and just recently we signed the African Development Bank signed an agreement with the world's largest pension fund, which is the Japanese government pension fund. But one of the commitments as a result of that is our effort working with partners to ensure a clear set of standardized policies across agri-SME to allow for trade, to allow for clarity of or certainty of investments backed by fixed policies, but also backed financial co-investment. So you might be aware of the Africa Continental Free Trade Agreement, and a big part of that is investing in agri-SMEs, and so we are going to be working together with them and others to really ensure that at the regional level and the country level, we are putting in place that enabling environment of policies and regulations that can increase the confidence of investors in this space. Monitoring and impact assessment, when we talk about tipping the balance of risk return by factoring in or valuing impact, we need to know, we need to be able to track these impacts. Investors will want to know for the funds for which are you delivering on the impact for which I provided these funds. So a whole set of certification standards will be needed that are based on the set of indicators, performance measures, and so on. And then, of course, a lot of capacity building work has to be done. Matchmaking, catalytic grants, as I talked about, proof of concept, to begin to, we see that the opportunity to increase the supply of capital is much more than the volume of available investor-ready opportunities at the agri-SME level. So a lot of work needs to go into really building that capability. And finally, like I said, we see a real big opportunity in the digital innovation revolution. a lot of the private equity investors, a lot of the guarantee schemes are now really investing very heavily in a whole range of digital tools to help improve their efficiency, to help reduce the cost of entry. For example, I think you're likely to be aware of the growing provision of mobile-based lending to the micro lender. This is being done by very sophisticated AI-based credit scoring mechanisms using, client, let's say phone, a whole set of data, including the phone usage data. What we're now looking at is looking at AI that will be able to credit score very efficiently companies at the SME level and be able to deliver both capacity training, but also finances directly to these companies and track them, and that will be a real game changer. So a lot of interesting R&D going on in this space that will really be able to speed the growth of agri-SMEs and improve the outcomes and outcomes that we've been looking at. So I think I'll leave it at that. Thanks for your time. I hope I left some time for conversation.
Thank you very much, Andrew, for that wonderful presentation. I would just like to open up the floor to Q&A. So you can raise your virtual hand or just, feel free to chime in. I would monitor the board, and if you can also send a question via chat. So we open up the floor for Q&A. I see Chris Barrett, Professor Barrett, if you can go ahead.
Yeah, hey, Andrew, thank you for a fantastic talk. Really interesting and always good to hear you. Can you maybe talk a bit about how ADB envisions its own portfolio or the broader financing landscape dividing through the value chain? I mean, how much of this are you imagining is going to wind up down on farm and primary production on land versus in processing and manufacturing and retailing, et cetera?
Thank you. You can address that while I...
Chris, thanks so much for that question, and thanks for being available at the talk. And this is a great question, and I have to say that the ADB is really growing its strategy around this space. It's also growing. For example, just I think it was in September when the board approved a new guarantee scheme, a new set of instruments. So that will provide more flexibility in the provision of that support. I think where we are currently limited, and there's going to be work that we're going to embark on, is to see if we can provide equity and debt to if we can reduce the threshold of 10 million to private sector non-sovereign investment. Because right now we're just limited to guarantees that provide to set of to PE funds and to some of these other national and private sector aggregators of RSFs. But in terms of the space or how we will distribute those resources across production versus across other elements, in the value chain, that is still not clear. What I can say is that our Feed Africa strategy really takes currently is very production focused about increasing productivity and yield. So if it is going to align with that, it is likely that it will provide greater support to those businesses that are going to increase productivity. But as I mentioned earlier, Feed Africa is going through a midterm review, and there is quite a bit of conversation that seems that is likely to shift that, with focusing on some of the outcomes that are required across the value chain, the provision of jobs and so on. And to the extent that will allow increased focus on logistics, on cold chain, on transportation, on innovation and development, on processing, a lot of impact on value addition, a lot of focus on value addition, that will be determined through the midterm review of the strategy.
Andrew, I have not seen another hand up, so I'll take this chance to ask my own question. And this is, when I was at the bank, you and I did have a chance to travel to South America and maybe part of Asia. what aspect of this problem is unique to Africa? As in, you know, there's big agribusiness corporations everywhere else, you know, they probably started out small, but, you know, in Africa, it seems that the space for SMEs quite big. Can you comment a little bit on what is unique about Africa compared to Asia, or is this problem universal?
That's a really good question, Ed. I mean, I think, you know, certainly while there's some generality about it, but in Africa, the returns to agri-SME business have been quite a bit lower. I think I showed that if you compare with Latin America, you know, Latin America has twice, you know, the returns are twice as high. But you know, it's interesting is if you look at for the micro level, particularly when it comes to innovations and in lending using digital lending and tracking, actually the returns there in Africa are shown to be quite a bit higher, and that's because as a result of the leapfrog that you know resulted in the mobile phone revolution. That was quite a bit advanced, and it provided an opportunity for a lot of providers, particularly, you know, some banks, some of this digital AI providers of credit coming to scale. So for that particular segment, you know, Africa is actually is relatively well off or equal to the rest. But I think for the segment that we're talking about, SMEs, we're a bit late in the game. I did highlight that they are once you have, for example, commercial banks that are starting to open their own agricultural departments, starting to build capacity, we are seeing an equalizing of those returns. Okay. So I think a lot of it is just you know the investments have been and the focus have not been as much focused more on production, and as we try and take advantage of the opportunities, we expect to be able to normalize.
Thank you. We have time just for one more question. Please, you can speak up just from the floor by unmuting yourself if you would want to ask a question. So I open it up. I see. Yeah, go ahead.
If no one else has a question, I'll ask one.
Go for it.
Okay, thank you, Andrew, for a really interesting talk. I'm curious about, with AFDB's blended finance initiatives, how do you think about monitoring to make sure that the investments and the specific kind of business actions that you're interested in promoting aren't things that would have happened anyway, to make sure that the public contribution to these to SMEs and other companies is additional rather than just a subsidy to an existing activity. And then I'd also be interested how do you think about, are there metrics or monitoring for non-commercial objectives or social objectives, or are the objectives of these funds purely based on commercial returns? Thank you.
And Andrew, before you answer that, let me take one more. Valentina, if you can ask your question, and then Andrew answer both questions. Valentina?
Oh, sorry, I forgot to mute myself. Hi, Andrew. Thank you so much for coming. My question is more related to, do you see maybe like African countries collaborate with each other? You know, maybe one area is specifically good at producing one good. Like, are there any policy kind of like, you know, lowering maybe tariffs for exports, imports? Just curious about that. I don't know that much.
Good question. Yes, Andrew, you can take those two.
Thanks, and Valentina. I think let me start with Valentina's question. You know, let's to regional trade. I think earlier I had talked about the Africa Continental Free Trade Agreement. This is an agreement that is starting to take shape and was recently ratified by the majority of African countries. And really a big focus on that is on improving regional trade. And so there's a lot of work that has been done to improve the conditions to reduce, you know, the range of barriers to entry and trade, reduce tariffs, to regularize also policies on agricultural policies, for example, so that, you know, a set of hybrid seeds developed in one area or in one country can very quickly be adopted without having to go through a set of regulations. So there is quite a growing amount of effort and recognition on the importance of reducing or facilitating improved trade in agriculture. So that's an encouraging. There's a lot of encouraging work and commitments at that level. With regards, Iwan, your question. So in terms of additionality, I mean, something that is definitely being tracked is the leveraging effect. You know, what is the for every additional public sector dollar provided, how much additional private sector is private sector additional investment. And we have certain metrics that, for example, in the Ghana model that I illustrated, there is a minimum requirement that after 3 years of that effort, at least a leveraging effect of 4 times. So additional private sector contributions must be 4 times the public sector provision and support. Now, how they track this is recognized. This is why, you know, one of the real areas that of investment needs to be in this is recognized to be around the monitoring, the evaluation, and so on. And that also then relates to your options. It's actually so to be more difficult to track not just the financial and commercial flows, but the impact, the additionality and impact that you're looking at. You know, whether it's you know, I know we were discussing with a fund that is really keen on providing investments to SMEs that reduce their biodiversity footprint. So how exactly do you measure and track that? And then how do you build the capacity of those firms to be able to signal that they're able to invest in ways that will maximize or even grow biodiversity? And so these are definitely you know, issues that are being considered. There are some instruments already in place, but a lot of work needs to be done to improve them. And this is why also my point that we believe that a set of digital tools could be the way to accelerate appropriate monitoring and tracking of impacts.
Andrew, thank you very much for your time. I wish we had more time. I just would want to ask the class and everybody else to help me in thanking Dr. Andrew Mude. If you want to unmute yourself and say, wave a goodbye or say a smile. So, thank you very much all for your time.
Thank you so much. Thanks for your time and interest. And I think, Ed, you have my contacts. They're available there. So I'm happy to follow up with anyone who might want to.
All right. Thank you. Have a wonderful day, everybody.